Today's curriculum, day 2 of the 2025 Master Trader Program. The second presentation of this session will be provided for you at 6 p.m. Eastern Time, New York time, and we will have Q&A after this last session of the curriculum. You can email questions to workshop@minervini.com. Do not type any questions into the chat box, as those will be ignored. If we don't get through all the questions today, we will have other opportunities next weekend on day 3 or 4. We'll let you know about that schedule, but most definitely on day 5, which is the live trading day on Monday, November 17th. With that, we're going to be picking things up on page 259, which is natural reactions. Do we have Mark here? And again, this last session should be the better part of an hour. We'll take a quick break. We'll close the room like we did yesterday, just for a moment. Uh, we'll reopen the room back up. That's just make sure you would do that right away. I know we had a couple of people had problems getting back into the room yesterday. My suggestion would be just to log right back into the room within the moment, even if we take a little bit of a break between the end of the curriculum and the Q&A. Let's just see. Stand by 1 second. All right, Mark is just getting back into his office, and please do reference page numbers, by the way, with your questions. Guys are doing really good with that. And again, stock related questions, things of that nature would be what the trading day is for. That is also where we will have Mark show his screening process. I know some questions have been asked. Remember, the questions should be on today's material or yesterday's, but nothing in it ahead of where we have already taught. So with that, let's pick up the last session on page 259 with Mark Minervini and Mark Ritchie. Take it away.
Okay, welcome back. I'm just scanning here and seeing what page are we ending on, Bob, today?
302.
302, huh? Holy cow. I didn't realize we are going into the failures and all that too. All right, that's quite a bit. All right, let me go back to the page we're on. Okay, so we've talked about the buy point, and we're gonna talk about that even more later. We're gonna see examples of IPO bases and so forth. And we're going to talk about risk and lots more on technical analysis. And this is going to be also on technical analysis, but now we're going to focus on after you've purchased the stock. Okay, you've made the buy, and now actually the hardest decision is the sell side. And when I say the sell side, certainly not the loss side is the easy side. The stop loss is just a number that we predetermine. When it hits that level, we're out. I'm talking about the profit side. I'm talking about selling the stock maybe before it hits your stop, and it's at a smaller loss or maybe a small gain, and the decision to maybe sell that stock and buy a different stock or to take the profit. You're going to have all kinds of emotions of selling this stock and, oh my God, if it goes higher, I'm going to kick myself. It's doing so great. The sell side on the profit side, I find, is one of the hardest. But what I focus on first, the very first thing I focus on when I buy a stock is the initial 5 to 10 days that it's trading, and right after it, the buy point is really important. And this is where what we're looking at, and this goes back to a couple key people. One is Jesse Livermore, who, as I pointed out before, said Never be afraid of abnormal price action, but but never be afraid of normal price action, but be very afraid of abnormal price action. Of course, you have to know what's normal and abnormal to make that even make sense, right? And that's why we talked about the train coming in on schedule, having all these reference points and this setup that culminates to this buy point right at that pivot point, coming out of the volatility contraction pattern, looking for the 1-2 punch, getting the volume coming in, if not on the breakout within a few days. Okay, great. You own the stock. The stock might be up a little, down a little, hasn't hit your stop loss yet. What do you do? What do you look for? What now tells you that the train is coming in on schedule? So there's another gentleman that, along the same lines of this thinking, the Jesse Livermore thinking, was said something to me that was instrumental in how I operated going forward, and his name was Bill Berger. And he managed the Berger 100 fund, which was doing really well at the time. It was a mid-cap mutual fund, and I happened to go to a conference. I was a big fan of Bill. I thought he was a great guy and a great manager. And um, I went. He was actually a good friend with Bill O'Neill. Bill O'Neill had a real affection for him. Um, I went to this conference, and Bill was there. So I went up to him and I said, Bill, just curious, what differentiates you? Why are you doing so well, against your peers? Is there any particular, thing that you can point to that is really the biggest reasons why you're able to do much better than everybody else in a business where, 80% of mutual funds don't outpace the S&P, and you're doing fantastic. And he looked at me and he said, son, I buy tennis balls and I sell eggs, and walked away. And that was the last chance I got to talk to him. And so I was left with that and had no clue what he was talking about at the time. And then over time, I learned and figured out what that meant. And I built a fortune on that. That one statement literally is the backbone of everything. It's not only the backbone of everything I've done up to this point, it's the backbone of a software technology that we have developed that I think is amazing. It's called Monolert. It's the backbone of that software, which we'll show you. So let's go back and let's look at some of these stocks. And now, of course, we already know they're in uptrends. So if I'm showing you a chart and it doesn't have the previous uptrend, you could already assume that this stock is in a stage two uptrend. It is trading above its 200-day moving average. The 200-day moving average is in an uptrend, and probably the 200-day is up for at least 3, 4, 5 months in virtually all of these cases. So, but now we're looking at just the chart, the current chart pattern, and we're zooming in a little bit. Um, so this is where I'm buying Lululemon. This is a VCP. This is a perfect VCP. Very similar, as we talked about before. You can see here you have a pretty well-defined area. It's bouncing off that 18. It undercuts it. You get a shakeout, right? This is a double bottom. And soon after, you rip up that right side. That's how we know this is a shakeout. We get that immediate bounce within days, or certainly shouldn't be more than about a week or two. And we run up the right side. Now I'm looking for that tightening. I'm looking for that volatility contraction and that pattern to develop. And right here, it gets really nice and tight. And this is a perfect example of where the pivot is lower than the high. So you don't necessarily buy and going into new high ground. You might be 5, 10% away. If you're a cheat, you might be more. If you're a low cheat, you could be 20% off the highs. Generally, we don't trade stocks that are more than 20, 25% off the highs. That's sort of the framework there as far as the boundaries. But after that stock is purchased, now we start watching it very carefully and seeing, okay, is this stock acting right? And should we hold it longer? All right. Should we hold this for a bigger move? And based on how it initially performs is going to determine, in many cases, whether we hold it through more pullbacks, more corrections, and if we hold it for a bigger move. So in this case, Lulu moves up for a couple of days and then pulls back. Now, one of the characteristics of natural action, natural pullbacks in a stock that is moving up after a breakout, is you get a number of days of pullback. So it's sort of a begrudging downside, slow kind of drifting down. And then you erase it all in a it's a much shorter period of time. See how it comes back for 1, 2, 3, 4, 5, maybe 6 days, right? And then within just a couple days, boom, right back into new high ground. It just rips higher. Same thing here. Move sideways, takes 1, 2, 3, 4, 5, 6, 7, 8 days, 8 or 9 days to consolidate, and then whammo, it's right back very quickly into new high ground. So, and this characteristic is just the opposite on the downside. If the stock was acting poorly, and it would be coming down quickly and begrudgingly rallying. So maybe you have, they call it a dead cat bounce. You have 6, 7 days. It goes up slowly and only goes up 4 or 5%, and then wham, one day it's down 8%. Day it's down 5%, and just a couple days it's down 13, 14, 15%. Erases everything. That's the worst situation. This is the best situation, right?
That's the egg Bill Burger's talking about.
That's the egg. Tennis ball action would be, and yeah, that's where we're going here. What's tennis ball action? Tennis ball action is it bounces back very quickly, very quickly. And what I've heard uh, other discussions from him, interviews, and what he said is that the subsequent action of after the purchase, after the stocks break out, after they emerge, the subsequent action tells him the most of how it acts. So he's looking to see if it has that tennis ball action, and we call it tennis ball action, where it's bouncing back very quickly. So we're going to look at a number of examples here, and that is, again, back to, is the train coming in on schedule? Well, for Netflix, right on schedule. It comes out perfect. Um, Pulls back for just 5 days, and look, one day back into new high ground, and look at the volume surge on the recovery. Then it pulls back for 7 days, right back into new high ground. Everything's acting good here. This is showing tennis ball action. This is a stock you might want to consider holding for a longer move. It
The
may
other
be
thing
only.
I'll just add to, and that I have in my very first manual, but and I remember Mark saying the best indication is that you're at a profit right away. And
That's right.
you can see even in this example where as the stock pulled back, or it just came right back to the breakout, maybe undercut it just a little bit. But the best situations, the stock is going to put you at a profit right away, and in some cases never put you under any pressure.
Yeah, yeah. The sooner you're at a profit and the better the stock holds up and rebounds, higher the probability and the more an indication that you're going to make good money on the trade. You want to be at means you timed it properly. The stock is under accumulation. There's not much supply they're selling, and you'll see this over and over and over, where you'll break out of the base. At some point, you'll pull back, and then what's the subsequent resilience? How fast does it snap back? Is it is there low volume coming in and then big volume as it moves back out? Is it erasing that pullback very quickly? Are the pullbacks short term in nature, and you want to spend too much time after you break out? Should be within few days to a few weeks. You're back into new high ground. Now, as a swing trader, I generally will go through between 1 and 3 natural reactions, and then I'm usually a seller into strength. If I'm short-term trading, I'm selling right into the first move, and I might sell part of it, and then that'll finance my risk, and I hold for a bigger move. Or if I'm really just short-term trading, I'm selling to the first move. If I'm swing trading, I'm usually selling into after the first or second natural reaction, part of it or sometimes all of it. And almost always, if I get a third natural reaction and the stock runs up from there, I'm selling it. So that's swing. Longer term, once you get through 2 or 3 natural reactions, you usually have to go through some fairly abnormal looking activity. Okay, and I'll show you what that looks like in just a second. But let's just keep looking at some of these. So here's Central Garden Pet, CENT. These are all stocks that we looked at previous with the VCP patterns, and now we're looking at what happened after the breakout and how this stock transpired. Here's your first natural reaction. You break out, looks very similar to Netflix. We had a couple of days down, back up, you pull back, you form actually a little mini, there's a little mini cheat area. You break out of there. Again, little natural reaction within just a day, you're back. Natural reaction, you're back in new high. So how many do you get? One, two, three, maybe four, three or four. So this would be, after the third one or so, I'd be looking to sell into strength. Now, if I'm playing this for a bigger move, well, then I might start backstopping, maybe sell part of it, finance my risk, use a break even or better stop, something like that. But swing trading, shorter term trading, after a few natural reactions, now what will generally happen is, and this is the natural reaction period. Here's CENT. So this is the weekly. We're looking at a weekly now of this daily action. We're looking at a weekly. So you can see how orderly it moves up here on that first move up, and it breaks out around what's it about $17 and runs up to 28. That's a pretty good move. That's a nice lick in what is it? I don't know, 10, 12, 13 weeks. But then you pull back and you start getting see bigger pullbacks and you take out the low, you shake out the low. Even over here, you get some volatility. And yes, it went out to make a bigger move, but you had to go through longer and deeper pullbacks where you might be able to take your money and this 5, 10, 15 weeks here and use it somewhere else, right? And then maybe this rebases and you come back into it. So that's why we swing trade. We swing trade because we can trade out of this very efficient move here. Mark talked about this earlier about that move up, that first move up being the efficient move. And then when it gets more volatile, we simply roll into another breakout and look for another efficient move and bypass this volatility. What that does is that makes our equity curve have very little drawdown because we're constantly stair stepping from this point, right? So if we sell into strength, there's no downside. And if we buy again here and do this again, well, then it's just going to go, it's going to look like we just took this and attached it to this. And instead of waiting this time and going through pullbacks, and this is why Mark and Brandon and myself, and we haven't had big drawdowns. We don't have many drawdowns, and they're usually not that large. I know up until just a few years ago, Mark, you guys in 15 years only had I think 2 years, and they were down 6% and 5%, which was quite impressive, yearly drawdowns. Peak to trough, maybe a little bit more. We get some double-digit drawdowns here and there, but that's the way you do it, and you sort of connect these S curves together. I don't know if you have anything to add
Well,
to
I was just gonna say there's that whole that whole bit about smoothing your equity curve is very, very underrated and
that.
almost talked about nowhere that I'm aware of outside of Mark's teaching.
Yeah, it's the most important. The most important element for big returns is not losing, is not having drawdowns. All right, that's how you compound because you're compounding money instead of compounding mistakes. You're instead of digging out of a hole, you're moving back into new high ground. So even moving back into high ground just a little bit could get you a lot further ahead than if you hold the stock down and it corrects 30%, and now you got to take 6 months for it just to get back to where it was. So that's why we want to avoid. Here's another stock. This is AMAG. I bought this right here. It had this little, you see this little, I'll zoom in on it. Right here, there's that little low cheat right here. I bought this right in here. Sold it into this first move up. Now, it made a much bigger gain, but again, you see very similar. Oops, sorry about that. You had to go through a bigger pullback, a pretty big shakeout, give back a good portion. Who knows? This might go down even more. You give back this much. I don't know how far this is going to go. Um, but I had to give back a portion and I had to take all this time. Now it makes another move. Once again, your pullbacks are getting a bit more erratic. So if you want the point is if you want to play for a bigger move, you're going to have to go through bigger pullbacks. You're going to have to give back a lot more. You're going to have more volatility on your equity curve. I chose to trade the most efficient part of the move, trade into strength, and keep my drawdowns as minimal as possible, and turn the portfolio over more. And that's how I've done it, and that's how Mark does it. Um, going back. when I first started, we couldn't do this. We they just couldn't do it because we didn't have online trading. There was a lot of reasons. The spreads, the commissions were big. We couldn't go back and forth. I was paying $275 for a commission. When I first started, it was so small that even if the stock went up 100%, I wouldn't even break even. So it was kind of just for fun in the beginning and just to practice. And I looked at it as, okay, I'll do this with small money. I'll pay this big commission, and if I'm good at it, I'll work, get some more money, and eventually have a bigger amount of money where it will pay. So I kind of just trade it for hobby and fun in the beginning, just to learn. So this taking a look here at STX, this was a trade that we just made recently, and very tight base here. You can see this is a little bit of an early turn. It was the first base after we turned up into a new stage two uptrend here. Right, here's the bottom in the market right here. So it came off. This was not a leader. This was not a stock that was holding up well during the bear market. This was a late bloomer that played catch up, but then was really, really tight, met all the characteristics, broke out here, and you could see a oops, sorry about that, very efficient move. Now, this made a very efficient move here. And now the correction gets a little bit bigger and you start getting the volatility. And this may make a bigger move. But again, the price is whipping around a bit here. Now, this is actually a screenshot from our own software, but what I'll normally do is that once the stock goes through those reactions, I'll sell if it gets extended. And we actually have a tool that follows the stock. It looks back at the stock 1 and 2 years and looks at its own character. And this is what you can do with your own eye. Everything I'm about to show you all started with me just doing it with my own eye. And now we've actually programmed it into software. But it will look back and look for the points that the stock was extended and where it had short-term tops, and then figure that out and then take the price where it is now and compare it and let you know, hey, this is getting extended here. So that's where I'll usually sell. I'll sell into the strength when the stock starts getting extended. So let's look at some bullish confirmations. Like, what do you want to see after you buy the stock? What are the things that are saying, yes, this is acting right. The train's coming on schedule, and I should try to hold this through, and that maybe a couple natural reactions here, or at least, go through another pullback because it's acting so good. Well, one is follow through buying. We want to see as soon as you can after you buy it, more buying, right? Maybe another day or two of buying after the initial day, or maybe you get a day or two pullback, but right away, buying comes right back, volume comes in, stock moves up another couple of days. You're seeing more up days than down days. You're seeing more good closes than bad close, and you're seeing tennis ball action. Let me show you how that looks. So here's a buy point right here, right? Stock comes out, pulls back for 2 days, right back into new high ground. You look at this 9 days out, it's up 7 out of 9 days. Natural reaction, tennis ball action. This stock's acting great. This is really acting really good. So this would be a stock that you might want to hold for a bigger move and not sell it too quickly. Um, right here, we come out. This has got follow through buying. 1, 2, second day buying. 1 day of pause, 2 more days. 4 out of 5 days up. Natural reaction, right back into new highs. This is one that you may want to hold through for another natural action and go for a bigger move because it's acting so well from the breakout. Okay, here's another one. This was that BB stores. See, acting really good. 3 out of 4 days up, very small pullback, back up into new high ground. Just 1 day pullback all the way up, closes to the high. 6 day natural reaction, sets up again. Little tight pivot. I mean, you could be buying this again here, adding to this. This is acting great, right?
I would just add too, I've found, and remember, you're not going to know this when you buy a name, right? So Mark is showing you after you're in it. So you've done you've done your work properly. Now you're in the name and trying to figure out, how much do I stick with this, and we'll add things to it. But when a stock gets into new high ground in a day after 4, 5, 6 day natural reaction, that's like the stock speaking at me. or at least saying, give me the benefit of the doubt. That doesn't mean I'm going to fall in love with it or anything. But again, that stronger and the quicker it gets back into new high ground, it's just telling you, it's giving, there's no sellers. The institutions aren't selling.
Yeah. Yeah, and you can see right here, I want to show you a little microcosm here. Even on here where you went up, up, volume, volume, the one day it paused. See that one inside day? Look at the volume come way down. See, that's constructive. That's constructive. That's a lack of supply. And then the volume comes right back in. That's very good price action. That's a stock that you don't want to sell too quickly. All right, this was an airline. 8 out of 10 days up. So you get the follow through buying. You go through that. Now, if you get a breakout like this, I'm going to let the stock pull back and see what it's made of. See if it can get back into new high ground. Maybe this next leg up, now I get a pretty decent gain and I'll nail some profits down. But if it's really acting great, I'll probably hold a piece of it, maybe sell half of it, sell a quarter of it, and hold a piece of it for a bigger move because it's acting so wonderful. All right, another one. This was Zillow. Zillow came out 7 out of 8 days up. 7 out of 8 days up, breaking out of a nice base like this, definitely going to hold through a natural reaction, hold through that, or at least a piece, back into new high ground. It was such a short couple days that again you want to hold to another natural reaction. This is just too resilient. It's so resilient that you want to give this a little bit more benefit of the doubt. And sure enough, back into new high ground. Now maybe here you sell some at the strength, right? Now you got a pretty decent gain. It's gone from you bought it around 57, 58 bucks. It's all the way up here, 90, $95. That's a nice little lick in in a month.
There's a perfect example of what I was just saying, though. See how in both those natural reactions, stock has a new high ground in 1 to 2 days, and it's telling you, look how strong I am, and where does it wind up going?
Yeah, the resilience is where you've got 1, 2, 3 days, 4 days down, one day erases everything, right? Couple days in, one day erases everything. Right? That's the tennis ball action. Right? Even here, you can see it comes in, what is it? 1, 2, 3, 4, 5, 6, like 7, 8 days. Within just a couple days, back into new high ground. Very resilient after being up 5 out of 6 days. So these are a bunch of examples. This was Google. Now, if you get this is what's called ants. This is something that IBD, David Ryan actually developed this for IBD. You'll see it in Market Surge, and we have it too in our software where it's 12 out of 15 days, the stock's up. Um, David started seeing stocks that he was selling that were going higher, and he was trying to figure out, you know, why are these stocks acting so well even after they're extended? And he found that if you had elevated volume during an advance where the stock was up 12 out of 15 days and it was up 20% or more, that was an abnormal strength and an abnormal amount of days up that or I should say, it was such a good showing that it indicated that the stock very often would go even higher. So this would be an indication of a stock that you may not want to sell once again, even though it's extended, keep a piece of it. And even look for maybe a new base to develop and then buy the next base that sets up. Um,
Golden nugget there.
yeah. Weekly, you're going to see the same thing on a weekly. Matter of fact, you can even sometimes see the natural reaction recovery better on a weekly because, like here, you can see it goes up and you've got 1, 2 weeks, really only 1 week where it goes inside and then it's right back on the high ground in 1 week. Here, you've got 1, 2, 3, 3 or 4 weeks, and then it's right back into high ground in 2 weeks. So again, you're going to see the exact same thing. You're going to see the VCP. Everything that we talked about on a daily should pretty much be occurring on the weekly as well. Good example was Netflix. After it broke out, it moved up, it drifted back, it drifted back. Look how long it took to go back. This is a weekly chart. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. It's like 12 weeks of drifting, drifting, came right back to the breakout point, and look, it explodes to the upside. Let's see here. I got to sneeze. So hold on one second. Let me just make sure. Okay, it went away. um, right back into new high ground in 1 week, and look at the volume. The volume's the highest volume in that entire period. So that's telling you, wow, so massive support there. A big tennis ball action. This is I I believe this one is DocuSign, um, and it had 12 out of 15 days
Yep,
up.
that's correct.
Yep. Um, See, okay, here it is. Yeah, so here it is where it gets extended. And see, so our software will tell you it's gotten very extended. It'll tell you if it's extended or very extended, and start looking for those cell rules. So here's the question here. We just looked at a bunch of these examples, and you've now got some models. Um, what do all of these examples, what does every one of those situations, what do they all have in common? First thing is they're profitable immediately. The breakout is successful. There's a successful breakout. And even if you have a stock that's not profitable immediately means within a couple days, maybe even a week or two, if it doesn't hit your stop and it's holding up quietly. But usually, in that first week, you want to see, even if it doesn't come out and take off right away, maybe it squats. We've been seeing a lot of squats and reversals on breakouts lately. You want to see it get back into new high ground. We call it a reversal recovery within a number of days. Within 2, 3, 4, 5 days, it should be back into new high ground. So that would also be, uh, uh, I would put that in the category of profitable immediately. There's follow-through buying. You're seeing buying come back into it, and again, in the case of it breaking out and stalling, that would be follow-through buying. If it came back and got back into new high ground, as Mark just said, you want to see these all had follow-through buying. They were all profitable immediately. They all had follow-through buying. They all had more up days than down days and more up weeks than down weeks, and they all had more good closes than bad closes on a daily and a weekly, and they all showed great tennis ball action. And the contrast in volume, okay, was very good contrast in volume where you saw high volume rallies and low volume pullbacks. Now, we're going to contrast that now and put that against stocks that didn't act so well. I call them no-nos. We actually have a screen. It's called no-nos after you buy. You set it, and then once you buy the stock, you can watch and see what happens and see if there's any no-nos happening on your stock. And those are the violations, right? The confirmations, we just showed you some confirmations. These are violations that you don't want to see. These are the bad guys, right? You don't want to see this. Let me show you how these look. And a lot of times you'll get these simply because you made a bad purchase in the first place. Like you didn't buy a stock that was set up properly in the first place, and you may not have noticed it yet. You're new at this, but this is your second chance. This is your chance to make it right, even though you don't want to now, throw good money after bad or compound a mistake. You made the first mistake, don't make a second and ignore the danger signs. So this is lumber liquidators. This was where it tried to break out of a later stage base. This was not a good base, but a base that somebody might have bought. Um, it tries to break out, right? The volume, it comes out on low volume, so you don't see much volume, and then right away, there's no follow through. It actually comes in. Okay, well, let's say we'll give it, like I said, we'll give it those couple days, right? It next day it comes in, 2 days down. All right, that's fine. Let's give it a little chance. Hasn't hit the stop yet. Comes up for a couple days, reverses, and then whammo. It comes in, it sells off on big volume, below the 20, below the 50. This is clearly not acting right. This is clearly acting abnormal. The train is not coming in on schedule. The train is going off the rails here. Immediately, you sell the stock. You're out. Matter of fact, once you buy a breakout from a proper base are the operative words, a close below the 20-day lowers the odds of it working, and a close below the 50 lowers it even more. Right after you buy it, within the first week or two, it should hold those moving averages. So another no-no would be, I call this low volume out, high volume in. So the worst case scenario is it breaks out on very low volume and then comes back in on high volume. Back in means comes back into the pivot and it goes the opposite direction. If it undercuts if it closes below the 20 to 50, that's even worse. But even if the volume, let's say the volume is relatively high, it does expand. You do get the 1-2 punch, and maybe it's even above average. But then the volume that comes when it comes back in is even higher than that. That's still low volume out, high volume in. That's high volume out, higher volume in. Just as negative. They're both negative. Okay. You don't want to see volume come in heavier on the downside than you came out of the base. And in this case, yeah, you would have this is a 50-day, you would have been below the 20 and then shortly after went below the 50. This is definitely a stock that I would be reducing immediately on not on this first day, not at that first day down, but on that second day with that close, I would be reducing. And then after that, you'd probably hit the stop here, but I'd be out. Um, let's see, wage. So again, this isn't a terrible base. It's a smaller base. It's not a terrible base. It's a base that you may be buying. It's pretty tight too. You can see 63-ish down to just below 60. That's super tight. So I could see myself. I think I might have even bought this one. I think this is one I did buy. So just so you know too, the the losers, most of them I did buy too, and not just the winners. So this one I think I remember being in this, and then I just sold it very quickly on that third lower low. So lower lows. All right, let's talk about lower lows. Lower lower lows are important when you start getting after 3 lower lows. Like 2 or 3 lower lows is natural, and that's where you'll generally get institutions that if they're accumulating the stock, a couple lower lows, and they'll start buying it again. Because what happens is they tell their desk, "Hey, buy 1,000,000 shares of XYZ." Okay, don't chase it up. Buy it quietly, build us a position. They start buying it. Okay, the stock takes off, and now they're exacerbating the move, and it's getting away from them. They back off. They back off, and now as it pulls back, they start buying it again. And they're not gonna wait. The manager wants to own the stock, so they're not gonna wait for it to come down and say, "Oh, I'll wait till this comes down to 54." No, they're just looking to get it and not run it up. So it comes back a few days, they start buying it again. Maybe it runs up again, starts pulling back a few days, they start buying again. So the normal action under that circumstance, if that's the case, which that's what we're assuming, when these stocks are breaking out of bases and there's no supply and is it an uptrend, we're assuming that they're building a position, that there's some institutions in there, and that's where we should see the support. So every lower low, especially if they're bad closes, and especially if it's on volume. So if these are bad closes, and volume starting to pick up. So these are really negative lower lows. And you close below the 50-day. I want to see support very soon. If support doesn't come in right here, no good. No good. That means institutions they're not in there, they're not buying, they're not supporting the stock, and this is very negative. And sure enough, we just come off here, one dead cat bounce, and we're a lot lower now, right? Very quickly. Let me show you another example of that. TRTN, this is a really good pivot. This is an excellent VCP. Okay, there's not a whole lot of supply above that point, but they don't all work out. Sometimes the market rolls over, sometimes news comes out, things change. So this breaks out, you get a little bit of follow through, but you get a pretty big down day and it erases everything. This is one that I bought and then I reduced it on this day. I said, this isn't the greatest action. Maybe it's just a short term little pullback, get back to the new high ground, but it pulled back pretty sharply. I'm going to just reduce. Then it can't rally. We get some lower lows, eventually 4 lower lows. I sold the whole thing here. So now I got out some here, some here. About the middle point, not too big of a loss. Now you get below the 20, you get below the 50, you got 4 lower lows, and you had high volume in. That was the reason why I reduced was because you came out, right, on volume, but you came back in on higher volume. And that means that that's selling that's picking up at a point where it shouldn't. It shouldn't be picking up that strongly there.
Well, I'll just point out two marks. A good example of because some of those other ones weren't the best pivots, where this is absolutely a great
This is
pivot.
a great pivot.
Yeah,
Yeah.
I'll take this trade 100 times out of 100. but you have ample time even to get, there's evidence that there's not the institutional support. But we're gone before then it becomes really clear there's no institutional support.
Here
Because
comes the big
institutions
selling.
are
Here's the big
becoming
selling.
net. Exactly. That's, again, that's not Aunt Betty or Uncle Bert dumping all that stock on the right-hand side.
Yep, that's right. Now you're at 1 million shares. Volume's really picking up. Same thing here. This isn't a bad base. This is OLED. I'm pretty sure I bought this. I usually when I buy it, it says I'm buying here, and this says buy point. But I'm pretty sure I bought this. I remember buying OLED. Um, so this isn't acting too bad. You're getting follow through. It's wedging up a bit. It's kind of begrudging. Okay, it's a little begrudging. And you see how it's begrudgingly moving up, but then it quickly moves down. If this came down for a couple days and showed supportive action, it wouldn't bother me as much. But you had a full retracement. You had 4 lower lows. You had high volume. Volume came in. You got below the 20, the 50. I mean, you've got a whole bunch of violations all culminating to that day. That day right there are all the violations all happening at one time. That's looking pretty negative. That goes from looking pretty good to pretty bad very fast. So you want to be quick on this stuff. You want to watch the stock very carefully in the first week or two. I mean, you want to watch it every day, of course, but looking for those immediate confirmations of violations
Back.
after it breaks out. You're looking for that follow through buying and seeing if it's acting normal. Now, if you can go through a reaction here and you get tennis ball action, great. Now the stock's acting fine, and it would be on the other list when we first started on the bullish action. If this pulled back for a couple days and then got shot right back into high ground, this chart would be over in the bullish charts. But
Mark, we
no.
bought, we did buy it on January 3rd and bumped it on January 8th.
So we on January 3rd, which is right here. This is
That first, yeah, right
so
there.
we actually bought it right here that day, and then we bumped it right here.
Yep.
So okay, so yep, so maybe
And
that's
then to Mark's point, see how it's in at 9 day,
right here.
9 day rally erased in 2 or 3 days. Exactly what an egg looks like.
Right. Right. See, just the opposite. It's begrudgingly moving up and then very quickly moves down. That's the opposite. If we flip this upside down, that's what we would want to see. Okay, let's see. Let's move to another one. Okay, so again, here's one where we break out of this base, right? And then we get 4 lower lows. Okay, this is where I want to start seeing support. And it started looking like we are gathering some support around that 20 day. And then it comes down pretty big, all right? High volume in. See, the volume comes in. This is a failed natural reaction. This is where it really, after you got those 4 lower lows, it should have started going back up. It's not getting back in. Okay, but still, even if this is one that you said, okay, I'm not down too much, I'm going to hold this. Well, now look at how begrudging this rally. This rally takes almost a month or 3 weeks, and then it comes right off. This circle right here. That's the last straw. You should not be in that stock anymore. That day tells you hit the bid right now. It is absolute failure now. And the fact that it took so long and was able to reverse it so quickly, you've now got it twice. It's showing you that characteristic. Okay, so
Yeah,
yeah.
remember too, nothing good happens below the 50 or the 200. You can see once
Oh,
the
now we're getting
this
below the
just has it
200
all. It just has it all. You should be
Yeah,
long
yeah, it
gone.
gets below the 200 and then it just implodes. So this is a stock you're buying originally around 22. A couple months later, it's down at 15 bucks. So this was one. This was Michael Kors. I had bought this over here actually. It was starting to set up here, and then um, it got tighter here, and I had bought it, and then it rolled right over, and I just got out of it. But then this started forming what we call a ledge, and we added this to the short sale list because you got a pivot failure, and you see it can't rally. It doesn't rally. And when you form these ledges, when you break and you break a pivot, you break a base, and you can't rally and you roll over, especially the 200-day, that's a real ominous sign. So looking for the ledge, and I'm not talking about just for shorts. I'm talking about just in your stocks that, how they're acting. Here's a breakout, 1 day breakout. You get a couple reversals. So that's the first kind of, okay, there's some reversals here, and the volume picked up. The second reversal that's bigger and outside day, the volume's bigger than the first reversal. You see, there's a couple yellow flags here. All right, but it holds. It's holding above your purchase price. Maybe you bought this on this breakout. Fine. It's not too bad. Now it begrudgingly, right, wedges up, comes off. We get 3 lower lows. Okay, now you close below the 20, you close below the 50. You got increasing volume. You got volume coming in. You got volume on the reversals. It's clearly going in the wrong direction. And then you can't rally. You form a ledge. And this is where it can get very ominous. When you can't rally, when the stock breaks down and you can't rally, that's where you really got to look out below. Um, so there's a number of examples here. This is 5. Now, I'm just going to go to page 292 here. You always want to look left for traffic, all right? So let's just say right here you're thinking about buying the stock. Okay, look to the left and look for the supply, right? Okay, maybe I didn't buy it here. I bought it, got stopped out, and now it got tighter, tighter. And now over here, if this tightens up here, this could be viable. But look, reversal, 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 reversal. It clearly right in this level right here, around 48 to 50 bucks. That is where your supply is. So where do I want to see it tighten up? Right there. I want to see that pivot develop right in here. I want to see that tightness in price. And then as I come out of there, that would be viable. But what happened? It went the opposite direction. It broke down. Volatility didn't contract, volatility expanded. And now you built a ledge. Ominous.
Well,
Now
Mark, maybe this is a good time to talk about the reintroducing supply as well, because that breakout, I remember this one. I bought that on the breakout attempt, and I just punted the whole position when it reversed because you had that big volume. Just telling me, we just brought more supply into the stock. I'm getting out of the way, and then you could see it came right back to that spot and then failed, and then obviously then rolled over.
all right, Mark, let me explain what you're talking about. So Mark actually termed the reintroduction of supply, which is a great observation because you can have a stock that sets up, right? Okay, so we deem this is tight, supply stopped coming to market, stock breaks out. But now we get this big reversal and we get this big volatility and volume comes in. Well, now we just reintroduced supply because these breakout buyers just got trapped, right? Unless everybody sold, which probably not, there's trapped buyers there. So on a shorter term basis, we ran into supply and could not contend with it, which is an indication that this supply is still an issue. And now we've reintroduced new supply, shorter term supply. Oh, lo and behold, we come back up here and it can't contend with it. We get a reversal and we need more correction because we still have supply. Now, again, we reintroduced some supply here. We got a big reversal, and we've got to deal with this. So the way we know that this supply stopped coming to market is tightness in price. And still, it's just an indication. It's not a guarantee. It's an indication. The only thing that's going to really tell us is if it breaks out and we get tennis ball action, the stock holds up. So, but that's the probabilities. We're playing probabilities, not absolutes. It goes the opposite direction. Take a look at this one here. This was the GT Advanced Technologies. This was a really good little pivot right here. Broke out, natural reaction. Look, a bunch of days, like 2 weeks, gets back into new high ground. But then you get the lower lows. You get 3 lower lows. It gets below. It can't rally. You see, it won't rally. There's no tennis ball action. This is very abnormal because this was acting great, and then all of a sudden it goes completely out of character. This stock went down 99% in the subsequent 3 months. So you've got to respect when that train doesn't come in on schedule, maybe it's broken. Maybe it broke down. Maybe the engine blew up.
And remember Mark's point about all stocks are bad. Here's a textbook example of what he
They're
means.
all bad unless they go up. If they're not going up, treat them as evil, evil beings that are there to cause you heartache and take your money. Okay, they're not good. There's no such thing. Just because you can have a good company, but there's no such thing as a good stock. What do all of the previous examples have in common? What does every one of those companies, well, every one of those stocks have in common? One, they all lacked follow through. In the bullish examples, they all had follow through. In these examples, they all lacked follow through. In these examples, there were more down days and bad closes than up days and good closes. The examples of the bullish cases, there were more up days, right? The volume dynamics were inverse. You had you had high volume on the downside, low volume on the upside. Tennis ball action was in reverse. You were begrudgingly going up and you were selling off quickly as opposed to the opposite. No tennis balls. Taking the stairs up, the elevator down. We want to take we want to do just the opposite. We want to take the elevator up, the stairs down, and then boom, the elevator shoots up again. So now you're able to see the difference between what a stock that acts right looks like and what a stock that's acting wrong. Now, it's going to take you a long time to get to a point where you'll identify this stuff. You're going to make lots of mistakes, and a lot of times you'll be late, and you'll go back later and you'll look at it doing post analysis and say, "Oh, wow, there it is. It was all there. Why didn't I just listen? Listen to it." Well, because you're a beginner, and you might not get it all in the beginning. It takes time. So just be patient with yourself because that's the number one thing with stock trading is you got to give yourself time to grow. You've got to give yourself time to become a champion. People, it's so funny, nobody would ever think of becoming a top surgeon, in a year. No one would ever think of becoming a major league baseball player in a year. No one would ever think of becoming a trial attorney in a year, right? No one would ever think of doing anything really, really great in a year or 2 years even. But for some reason, people open a brokerage account, take a seminar, read a book, and they think they're supposed to be trading like a market wizard overnight. It doesn't work that way. Matter of fact, this is harder than all those things. This is harder than becoming a doctor, a lawyer, a basketball player. This is going to be the challenge of a lifetime. But
That's the difference. They'll let you lose your money day one. In medical school, they don't let you cut someone until you've
that's
been through residency and years of education.
that's right.
And thank God for that, by the way.
Yeah, just imagine if we had a karate tournament, so we told the white belts, yeah, just come right in and compete with the advanced black belts. It, it'd be some serious injuries, right? So yeah, that's what happens here because the barrier to entry in the market, there is none. All you have to do is have money and open a trading account, and you're a stock trader. All stocks are risky, okay? And you've got to respect that risk. We're going to talk about risk a lot in a very, very deep, deep, deep section, but we'll get to that. That's on the final day. Let's talk about, I want to back up a little bit. I want to go back to the volatility contraction. I want to talk about the count because sometimes you get a setup and you get exactly what we just saw where you've got some negative price action, but that doesn't mean it's the stock is done. All right. It could still work. It could still set up. So you don't want to abandon it if it's still staying in a base and it still meets the criteria. It may just be where the volatility widened a bit and it's just premature. You just bought it too early. So if you have a stock that it goes through the iterations, and so let's say it tightens up, and right here, this iteration right here is, let's call it 8%, or well, actually, I'm sorry, let's call it 3%, and then it undercuts that, and you get some three lower lows, four lower lows, or some violations. But this is only let's say 8%, 7 or 8%. It's still single digits, and then it breaks out. Well, the count would now be 1, 2, 3 to here, which was 3 here. This is now 3 because it's still 3 because it hasn't gone down enough to not be a contraction. If it went below here, then it would be a 2, right? So you want to stay with the count. You can have a stock, it's setting up here. You're looking forward to it setting up, right? Okay, great. If it breaks out, wonderful. It goes the other way and the pivot fails. Well, that for the moment, yes, you're going to step aside or maybe you're going to not buy it, right? So, for instance, this is Dick's Sporting Goods. I saw Dick's Sporting Goods right here when it had this IPO base. And this is a very nice right side. If this just stayed tight for a couple days and it broke out, I would have bought this stock, but it didn't. So I never got a chance. I didn't get a chance to buy it. So what can happen is sometimes you can have where that stock will undercut and then take off, but that pivot point is still tight enough. Sometimes it's not, and it needs to reset. This is what we call a pivot failure reset. So if the pivot point is tight and then you undercut it, that's called a pivot failure. Well, if you get a reset, the pattern can actually strengthen. Now, I'm going to show you a stock that happened. This was a stock that I had bought right here, and then it came off and it stopped me out right here, right on the low that day. I got knocked out. Now, the mistake was not selling the stock. That stock hit my stop. That's where I set my stop. So I have to sell and honor that stop. But then it came back and it tightened up and it reset. And the mistake was not buying it back because it went up 90% in 26 days and it was set up perfect. It was a perfect reset. So sometimes these stocks will stop you out, or maybe you won't even buy it, and the volatility will come back in. You'll reintroduce that supply, but it'll deal with that supply pretty quickly, and it will reset. This can happen in a number of different. It can take place in a lot of different forms. This was symbol YY. You had a pivot that really wasn't a great pivot. Sometimes this will happen when the pivot's kind of questionable. It's not. Whoops. Where's my thing here? So this pivot, it's 2 days. That's not a great pivot, but some people might buy that. It needed a little bit more time, and now it reset. Even over here, right here, it technically broke out right there. It needed a couple more days. So it didn't actually fail. All right, let's look at another one. So here you got a couple buy points. This would be a sloppy buy point. This is a great buy point. This is an excellent base. Perfect VCP, breaks out, comes in, this probably would stop you out. This percentage move would probably stop you out. Then it resets here, stays tight. You get a little cheat, low cheat, but that shakes out. And finally, you get another reset. But see, now you've got a much bigger base. So sometimes you need to go through a longer period of time because that supply is just not gone through where it's been diminished. This was Spirit. This was one that David Ryan and I were online with each other, and this is one that we both were buying, and we were looking at this little. And this is I was talking about low cheats and cheats, and he didn't like the low cheat. He didn't like the cheats at first. He certainly didn't like teaching them to people because we would be at the Master Trader program, and he would actually defy me in front of the crowd, and I still would talk about it. I didn't care. I knew it was coming. But to his credit, he did say later on, after a couple of years later, he said, "Okay, the low cheat's a good discovery. I use it," and he agrees that it's a valid buy point. But he felt like it's a very expert buy point. It's harder to execute because of the supply. It's introducing another element and not keeping it as simple, but I think it's really important because sometimes you don't get any other buy point. You see here, this broke out here, came back in, and then set up this little low cheat, and then you never got another buy point. The stock just took off 5 days up, and now it's acting great. Almost 80% in 10 months. That's a nice little move. I'm just showing you a bunch of examples and trying to.
I'll add to it. I did not buy that at that point for that very reason. I can remember.
Yeah,
I
that was.
remember
This is stretching it. This is definitely this is about as stretchy as I stretch it. This is a we call it creativity. We call it creative. Sometimes Mark will come and he'll say that. Well, that's a pretty creative buy you're doing there, which means it's kind of a shitty looking buy.
Well, for me,
But
what it usually means is to teach me what you're looking at, because what you're gonna find is, to Mark's point, and his point earlier about art is really a good one, where he said, look, there's boundaries or perimeters, but then within those, and like this is, I think trading is, it has scientific boundaries, and then there's art in between there, and this is a very artistic buy, but it's very
Well,
low risk.
yeah, it's low risk because what happens here, now that this stock broke out here and you got this shakeout, this really should go right here. If this rolls over from here, now you're going to be closing below the 50 to 20. You're not that far from the 200. I mean, you failed now a second time. It really would get ominous looking. So, and you're not far from these lows, so it's not you're probably not looking at a very big stop. So this is really trading what we call near the danger point, which we'll talk about later. Trading near the danger point. Trading is close to where the trade sours, where it's just not acting normal. So this would look even more ledgy if this started rolling over from here. Now you're having to look at this more as a ledge. But what I'm showing you here, what I'm trying to show you is that there's a lot of permutations. There's a lot of ways that this can manifest itself, these resets and these pivots. Some of them I'm showing you some kind of, I showed you perfect setups. Now I'm showing you some not so perfect setups, but still within the boundaries of being buyable. But you got to just be really quick. If they don't work, you're out of there, and you can be creative with this. Um, Now, I want to show you a scenario on how, again, context is really important. And if you get a shakeout, like something like this, where you set up and then you shake out and reset, this becomes much stronger if this shakeout is on a market decline. Like for instance, you're in a bear market, right? You've come down a couple times, a stock has set up, and whether it breaks out or not, it gets wider and looser, and it shakes out on a plunge down in another plunge down in the market. So this is how it might look here. Okay, here's the general market. It's started to pull back. This stock's tightening up. It tries to go, but the market sells off and it takes the stock down. But now the stock comes right back, retightens, and as the market starts turning up off the lows, it's right back a new high ground. That's showing some real resilience. And this is saying that this shakeout was just the market just suppressing it, and it wants higher because it did not succumb to it, and it tightened. That's the real important thing. After that volatility, it tightened up. And as long as you're getting that volatility contraction, this is really a very solid buy point now that it went through that shakeout. If in fact the market came off big here and you can blame it on the market, let's say. So that's kind of a scenario where you'll sometimes see these failures, and you'll even see that where with on a bigger level, all right? So bigger corrections take even more time. So maybe you set up a smaller base, right? One, two, three, you contract. But now you roll over and you undercut the lows, and not only is it a pivot failure, it's a complete base failure. You take out the low of the base, now it might take time. You might see a cheat, maybe a low cheat, a handle, because you're building a much bigger base. This can happen because of bigger pullbacks in the market, bear markets. This happened with Elan. It formed a base, not the greatest base, but it did form a base and it tightened up right here. It tried to break out, but the market had already topped right here and it was making a new leg down. The market bottomed right over here. So, like the worst part of it, where the market was really volatile, was right here. And that was enough to push the stock and suppress it. But then a little bit later, and as the overall market built this big base and right on schedule in January after we went into Iraq, all these couple of handles formed, and this got really tight. Look how tight those few days are, and now you really formed that nice right side. Look at the volume come way down. I bought this stock right here. I was buying this stock. Let's look at go back to Dix. Now, exact thing happened with Dix where it formed this little base, right? See this little base right here? This line right up here is the S&P 500. See, the S&P rolled over, it went into new lows. So there was a market correction that took the stock down. But then right here, they raised guidance. They increased their guidance. The stock rocketed up, and right off the market lows, it was setting up and it tightened up, and now it's ready. It's ready. So over here, I might have been in this and I might have got knocked out. But even if I did, I'd be right back in it over here because now it's really setting up quite nicely. And you can see the market was weighing on the stock. This is what we call a base failure. It's a base failure reset. You have pivot failure resets. You have base failure. Sometimes you get the reset because the first base was just faulty. It was V-shaped. The right side wasn't formed very well. This is a faulty base. This is not a very good base. It's V-shaped, and this right side, you can see there's shakeouts. The volatility is what I call this the megaphone effect, where instead of tightening, you're widening. So you tightened up, but then you widened and you came out on a wider volatility. That I don't like. That's not how I want to see my stocks break out, and they're more failure prone. But this stock just took time, and then it built a really nice right side. And see, so you stick with it. You stick with it. Sometimes when they shake out, they improve. This setup actually improves. So you might tighten up, and then the volatility widens. Now, is 18%? If this was a scenario, is that a contraction? Is that your last contraction? No. No, that wouldn't be, well, I should say a viable contraction. No, you need more contraction. So if you have 33, 15, 8, what's that? 3, right? 1, 2, 3. Okay, well, now it goes down 18%. So what's the count there? The count's now 2. All right, so 1 to here. Oops, sorry about that. They keep moving that. And now from here to here, that's 2. But it's not tight enough yet. It has to get tighter. Well, now it does. That's 3. Okay, now it's buyable. So what once was this setup now fell apart and then reset, and this is even a better setup because now we shook out these lows. Now we shook out all these lows and we got rid of more weak holders. So the line of most resistance becomes the line of least resistance. Okay, so another question. This stock here, is it buyable here, coming out here? 1, 2, 3? Of course, right? 4%. Well, now it fails, takes out this low. Forget about this 3%. If this just came right out off the lows up, is this buyable? Answer is yes, it's buyable because it's still single digits. And now 3% pullback comes out here. Is it buyable? Yes, it's buyable every one of these times. So anywhere on this right side, if it goes into new high ground, it takes out these highs, it's buyable because that right side is now developed into the proper percentage. However, where's the count? Once this goes below here, that was a 3 count, right? This was a 3 count. This was 1, this was 2, and this was 3. But now we take out that low, so now this is 3. We got to recount. This is 3 now, and now this is 4.
Yeah, 171 mark. NVIDIA is a textbook example of that as well. We already covered.
Go see. 171. Let's zoom up a little bit. Yep, here you go. So you actually you tighten up here and you come off a bit, but you don't come off enough. This is still tight enough. This is still tight enough. This is what you're talking about, Mark?
Absolutely. You get the 3 contractions there. Initially, it's looking even tighter, but that, like you said, you get that little undercut of the third, and then you do the third count starting from that other one.
All right, there's one. There's one. There's your second pullback from oops, sorry about that. From here to here. And then yes, this one would be right here, but it fails. It doesn't break out. Now that it doesn't break out, our count is going to go from here to here. So there's your 1, 2, 3. It's still tight enough. As long as it's tight enough on that right side. If it's single digits, it's tight enough. It's tight enough. It's buyable. See here, where are we? What page were we on there? I'm just gonna get back to where I was.
315, I think.
316 mark, and actually I did not stop you, so we went one section longer than we were supposed to, but
Aha.
this is the conclusion on 316 of the failure reset. There we are. So we're going to wrap up today's curriculum for day 2 of the 2025 Master Trader Program. And we will have still time for Q&A session where I have already plenty of questions to ask, but you can still send more to workshop@minervini.com. Mark, we want to take a break, 10 minutes, 15 minutes. What do you want to do?
15, 2:15.
Okay, so it's 1:54 right now. Why don't we pick it up at 2:10?
2:10.
That'll be 15-minute break. And what I'm going to do again, as a quick reminder, I'm going to shut the room down right now and then reopen it immediately. So just come right back in, log right back in. But that's what helps us with the our logistics on our side. And with that, tomorrow reminder, 9:30 a.m. for New York time. That is for I'm saying tomorrow.
No,
Listen to
not
me.
tomorrow.
Saturday.